When something is free, we always consider that there might be something wrong, that there might be a catch. Well, Fidelity has developed a few years ago the zero-cost mutual fund, which basically means you can buy the mutual funds and not pay anything in expense management fees. So you're managing the money for you for free. Well, let's see how that actually helps Fidelity and what's behind the business model. So Fidelity, we know, is based in Massachusetts. It's one of the biggest asset managers in the world. It's also extremely well positioned in the administration of plans on 401ks and health savings accounts. Indeed, we can see that assets under administration were up 30% year over year from 2023 to 2024, $15 trillion in their platform. That doesn't mean they manage them, they just hold them. And also discretionary assets. These are the ones they actually manage. By the end of quarter three of 2024, they were close to $6 trillion, 5.8, little shy from Vanguard and BlackRock and State Street. But it's the customer planning. Fidelity is built based on engagement, and it feels familiar. And actually, the platform is really good. So the zero-cost mutual funds, their business models attempt to do two things: enhance client retention. That means create more and more organic growth via client retention, and also generate yield with park cash. Kind of like when Charles Schwab launched its robo-advisor for free, but then all the funds were 8 or 10% in cash, which they can use that cash, lend it, or maybe invest it in commercial paper and make a yield for it. So that's usually how these models work. So, for example, the Fidelity Zero Total Market Index Fund and the Fidelity Zero International Index Fund is pretty straightforward, right? It's basically the total market that other companies provide. The funds are only available to individual retail investors who reside in the United States and purchase shares through a Fidelity broker account. So in order to access them, you have to open a broker account with Fidelity, which then, that's exactly the point. Now that you have an account open with them, then you're going to start parking your money there or start using or utilizing other products that Fidelity shows or offers. So the hope is that after opening an account with Fidelity or moving your $1 million account to the brokerage, you will decide to place stock trades, maybe like at $5 each, although most of the trades are now at zero, but some are still at 4.95, or put some of your money into its other mutual funds, which actually have management fees. So it's actually a great marketing strategy to engage client acquisition. But if you keep any spare cash in your broker account, right? If you move, $1 million and you only invested even $995,000, that $5,000 that is left there can be used by Fidelity in other ventures. So let's say you are managing $100,000 in a mutual fund at zero cost. For instance, not concerned, but a mere $1,700 in cash holdings generates the same revenue as a 5 basis point management fee on that $100,000 portfolio. Why? Because Fidelity is able to lend that money or to short sell your stocks or to go and with that money create some spreads in different products. So that's how it works. Even a mere 1.7% cash holdings is what it generates a 5% basis management fee. And if you think about it, the VOO or the SPY, which also track the S&P 500 by Vanguard and by State Street, they charge 3 basis points. So even Vanguard at 3 basis points will be making less money than if someone leaves 1.7% of their money park instead of investing it. So, of course, rather than relying on traditional asset-based fees like other companies do, the true revenue driver lies in capturing client cash balances as a source of profitability. Now, if this is fiduciary or not, I don't know. That's not my concern here. I think the platform is really good, and then there's a benefit of also having 0% expense management, but that's just how the business model works, totally legal. So, and as we said, unlike BlackRock or Vanguard, it's owned by just one family, the Johnson family, which revolutionized how the mutual funds work. And we understand they also had a Peter Lynch in their funds, one of the best portfolio managers in history, which really captured a lot of client and a lot of money and making it into a great company that it is today. So it controls corporate America through the 401ks and all these funds, and influences global finance because it has a lot of assets under management, and it operates in certain amount of secrecy because you don't have to present any shareholder reports or your earnings. So I think it's a great company, but we just wanted to explain the model of how it works. So let us know what you think.